Hi, it's Jack from Alpha Charts with a state of the market video. Today is March 5th, 2022. Before we get started, this video is for informational purposes only. These are not recommendations to buy, sell, or hold any stock or security, and I may hold positions in some of the equities mentioned. Know your time frame and risk tolerance. All right, so let us start. It's been an interesting week. I did put on some test positions this week, which failed miserably. I was kind of pissed because, yeah, I know better. I do these videos. I know that we're in a pretty crappy market. It was actually looking kind of nice, but really bear flaggish when I look back and look at it. So anyway, they mostly stopped out. Stops are in. Gotta manage risk. All right, let's get going though. SPX. We still have this beautiful topping pattern that's kind of developing. And again, it doesn't develop overnight. It's a process, but you're having your 50-day now, your 200-day now is flattening out, still kind of rising, but to almost like a flattening position. Price under all moving averages. I mean, this is the relevant low, 41.17. It's got to hold above there to do anything. And maybe it does. And maybe it, somehow it goes up like that. Maybe it comes down, maybe it undercuts, maybe it makes a higher low, whatever. Maybe it makes some kind of bottoming pattern this way. I don't know. But I think that's a lower probability. I think further downside is more likely. And I wanted to show this. So SPX on the monthly. Now I know we're on the 5th day of the month, so this last candle, you can just ignore this last candle for all I care. Right, so let's just ignore that last candle because it's only 5 days in. But let's look at this chart real fast. So this is a monthly chart, and again, let me get these moving averages off for now. Monthly chart of the SPX from the 1932 low, right? This is the Great Depression, and this was a big deal. So when looking at the big picture, I can make the argument that this is a 5-wave count higher. Not Elliottian or anything like that, but there is something to the 5 waves, and I can make the deal that we are at the end of a 5-wave cycle, potentially. That's gigantic. I think that's a big deal. This trend line from that low, I think, is significant too. Now, before we get too worried about this trend line and coming back, because if we did come back to touch it, we are talking about, 55% or so in. It can take, 74, 78, it can take years for it to touch this trend line, right? So I don't think it's going to touch the trend line in 2022 in any way, shape, or form. But just know a reversion to the mean or the this trend line is a possibility. But if it does work that way over the next 5 or 6 or 7 years, I mean, are we in a period like the 70s? That'd be rough, right? I mean, I don't know. If you think about like something like this, it got really extended here, and it took a decade, and it took the 2009 housing crisis to bring it back to the trend line. Well, that was from 01, it pulled back, and then came back and then pulled back again. I mean, so that's literally a decade that it took to touch this trend line from this peak. So again, I don't think that's going to happen overnight, but are we in that type of environment? And again, this was a great rally right here, right? From 02 to 07, 5 years of fantastic, for the most part, fantastic price action. The last thing I want to show you is this monthly MACD cross right here. So the monthly MACD cross is a big deal. It has really, really been a great signal of risk on, risk off, and we just got a bearish cross. So that's significant in my book. It's like, we have to make, a case, a bull case or a bear case, right? That's the whole point of this video. This is a big check mark in the bear column. Yeah, that's pretty nasty looking. So again, a monthly MACD cross, very, very strong signal for potentially further downside. So, all right, let's keep going. I came across that this weekend as I was doing my prep work, and I just wanted to kind of share it with everybody. That's not fun. All right, let's just go ahead and get the 200-day back on here and move on with the video. Looking at the cues. All right, here are the cues. And the cues looking at fibs, right? So let's go to the weekly chart and let's look at the Fibonacci retracements and where are we at with this. All right, so we have, COVID lows to the peak, and this looks like it could be an ABC pattern. I mean, I think this 300 level is a spot that has to hold. I would be very surprised if we didn't get there. I think that's going to happen. I think, and that's about 10% from here, right? Just a little bit over 10%. Yeah, 10, 12%. Yeah, so I think that that this rollover is happening again. Cues underneath all moving averages. You have the bearish cross there. You have flat 200-day. I mean, there's just nothing bullish except that maybe you say, okay, well, this low was significant. Well, you're still making lower highs and lower lows. If this could just be another lower high, and then this may be the lower low. Cues pretty nasty looking. Here are the equal weighted cues. And again, there's many different possibilities here. This was a trend line I was kind of watching for, and I was starting to get a little optimistic that we may break out of it. It didn't roll over, so I'm going to clean it up just to clean up the chart a little bit. And so I don't know. This came back down, retested. Here's a VWAP from the COVID lows. Does it bounce here and we go higher? Less likely scenario. I mean, we talked about this head and shoulders and its larger head and shoulders top. Again, is equal weight, which means broad-based destruction in the markets. This 59 area, 58, 59, that could be significant. I don't know if we're going to bounce first and then roll over. I don't know if it's just going to tear right through it, but a break of this area and of the VWAP, I think $70. If price gets below $70, there's a lot more pain ahead. That's pretty bad. Again, that's about 20% to that potential support area. So not good looking at all. IWM, again, we talked about this, just reiterating it. I mean, 1, 2, 3, 4, potentially the fifth wave down. Very significant area right here, this 166 area. So we will see if that is, if that gets hit or not. Again, going down from there, we're looking at another 16, 17% down. Okay, so that's not nothing, right? All right, let's look at this one, IWO. Again, this is small cap growth. And this one actually is almost to that particular area, right? So small cap growth is leading to the downside. It has about 7 or 8% more, you can even say maybe 10% more to potential support. It's already under the VWAP from the COVID lows. It is, I mean, the bearish cross between the 50 and 200s happened a long time ago. Now the 50 is crossing the VWAP from the COVID lows. I mean, there's nothing good to see here. Potentially another 10% move to the downside, and then we'll see what happens, right? It's if it gets extended to the downside, then maybe you get a nice counter trend rally, but still extremely suspect. I mean, and the reason is because you're now really extended from the 200-day moving average, right? So one more push down, you're gonna get really extended, and then you get the mean reversion, right? Then it could potentially roll over again, or who knows what. But IWO, not looking good either, leading to the downside. Definitely not what you want to see. And just looking at mid caps real fast, MDY. So MDY holding up better than most, right? Here's your mid caps. Here's this. Right there. Again, the mid caps holding up better than most. They probably have exposure to oil and gas. If it did fall, roll over, it's about 21% decline. You have the cross right there. You have a flat 200-day. There's no reason to think that this is going to hold up, right? I think decline is definitely the more likely scenario. So there's that. So none of the indexes are looking good. They're all look pretty garbagey. Financials. Well, here's financials, and financials look like they want to roll over, right? I mean, so they've been in this they broke out, then they've been in this range. Now they're under the 200-day. We don't have any kind of death cross or anything like that going on here yet, which is good, but just get rid of that for now. But you're under the 200-day, and you're flattening out on both these moving averages. That's not leading, and that's not participating. That's holding on for dear life, right? So XLF not looking good. SMH, we talked about the broadening foundation formation back here in December and how I was a little worried about that. And it did break down, and now it's come to this area. It's holding, but again, it's under the 200-day. You got the 50-day screaming lower. Nothing bullish here. More than likely, you're going to see a test of, this area right down there, 13% lower right there. And then we'll have to see what happens. But pretty ugly looking price action right here. SMH, not good. Lumber is trying to make this base, couldn't, failed miserably. It's not leading lower, it's not diverging, so there's no real signal here. So we'll just move on. The VIX elevated at 32%, 32. It's elevated VIX, right? As we would expect. So here's in the chart, the bond ratios that I've been concerned about more recently. And let's just get rid of all this stuff to make it clean. All right, here we go. So I don't like this sharp move right here. A break above 1.54-ish, 1.55-ish. And man, you could have a situation like this, which is a widening of credit spreads, which means the bond market is extremely concerned of systemic risk, right? So one of the things for this video that's really important is that I'm trying to find systemic risk. COVID was systemic risk. Let's go to a weekly chart just to look back over here, okay? COVID was systemic risk. Last time we saw this was the Fed tightening, right? That's what I believe this area was. 08, systemic risk. So as you can see, every time there's a pretty big downturn in the market, credit is usually showing the way. I am concerned that we're starting to see some of that show up in the credit markets now. It's a start, and it could get real scary real fast, and that gets nasty, like real nasty real fast. Again, it's the velocity as well as the direction. So be careful out there. This makes me very, very concerned. And it's been working on this way since January, right? We were doing fine. Even this was a little concerning back in November, but then it rolled over. Great. Listen, if this rolls over, no big deal, right? It's a false alarm. But this was worrisome back in July, and the summer wasn't good. But it rolled over, and that was nice to see. Made lower highs, whatever. Well, now I don't know. We'll see. But again, if you see this look more like this, and continue to look more like this, because it's starting to, I would be more worried about systemic risk in the market. And just let's look at 10-year yields just for fun. Yeah, so they came in a little bit back to 1.72 after they hit the target of two. I still think that there's a very good likelihood that they get into this almost 3. I don't know if they're gonna hit the trend line. Again, this trend line is a serious trend line. It's from 1981 peak in interest rates. That's a problem, right? That's a problem if this trend line gets taken out. This is a big time trend line. Let's go to weekly so you guys can kind of see a little bit better. It's a big time trend line, and it's significant. And if interest rates get above 2.8, 2.9, somewhere in here, and then hit 3 and break out of 3, ooh, that's a problem. Again, these are very long-term ideas. So don't think like it's going to hit 3% tomorrow. That's not what I'm saying. But if we see the 10-year rebound here and start to move higher and get above 2, that's significant. And I think that this 2.8 to 3-ish is in play. And again, that's not a very good market for equities, rising rates like that, in my opinion. Makes everything more expensive, right? All right, let's keep going. Put call ratio. So everyone must be bearish right now, right? Nope. Actually, they're right in the middle. 1 foot in the door, 1 foot out the door. There's a lot of room to the upside right here. Nothing like a 10 to 12 to 15% move in equities can't flush out. We got a few bearish pieces, but not nearly extreme enough. So look for that flush and put call ratio to get very bearish. It's not bearish at all in sentiment, in my opinion. This is a long way to go. So I wish we were more bearish, and we're not. Looking at some breadth studies, value line geometric index. Yeah, as you would expect, right? It's rolling over. We had this topping pattern, looks like the IWM, and now it's starting to roll over. Breadth is deteriorating continually. Looking at the percent of stocks above the 50-day moving average, it's at 34. I like a flush to about 10% for extreme, right? Anything at 10 or lower. And I think that that's a potential buying opportunity as a contrarian. Again, don't know if it'd be, long term or not, but a buying opportunity nonetheless. Looking at gold, gold is finishing up its pattern, man. Look at that, straight up. Looks kind of like the bond ratio a little bit, the way it's moving, right? People are rushing into gold, right? They're not walking into gold, they're running into gold. And this gigantic pattern, right? It's talking about 10-year pattern is finishing. And then what, right? A break above 186-ish, 186.50, even 190-ish. And this gold pattern is significant. So you're seeing people are positioning now for more pain to come. And then, of course, we got to look at Bitcoin, because the riskiest of risk assets and what's going on with Ukraine, and our people, are folks using Bitcoin to circumvent, whatever they're doing there. So in my opinion, the riskiest of risk assets, which is what I am using this for, we are below the VWAP from the peak. We are below the VWAP from this big volume day right here. And let's just put the 200 on here too. 50 day, it's there, right? The 29, 23. Let's just do it all. So when we're looking at this chart, this was a big day right here, big volume, and we're below that again, below it from the peak. So this could have been, hey, we're just kind of making the right side of a base, which is what I was really looking for last week. 3-4 days ago, it was looking good, and then it kind of fell apart. So underneath all these VWAPs, it looks like it's rolling over. I still think 30,000's in the cards for this particular one. Don't know where it's going to hit it, obviously. and 30,000. If it doesn't hold, 20,000. Okay, that's just what I think. I may be wrong. Don't blast me on comments over that. It's just, there's not much volume in here, right? So there's a big volume void right here. So anyway, Bitcoin being risky, the riskiest of the risk assets, rolling over, not good. So I think caution is the way to go. Actually, I was gonna try to do a color coding system or something like that, but this week it's definitely defense, defense, defense. If you are short or want to play short, I think picking your spots, because again, rallies could be intense. Rallies could be intense also. So you better know what you're doing if you're going to be shorting. But shorting indexes or something like that may make sense, especially if we start to break down from this area. The MACD cross is significant. That's now you see like on the daily, like, it's got a cross here, but still under the zero line. And this is just a very bearish look to it. But on the weekly, again, it crossed, kind of intermingled for a while, and then crossed right back here, and it's going below that. It's going below the zero line, and then let's look at the monthly, and there you go. There's your cross right there. The monthly. This is the signal that I was talking about, and just for funsies. As you can see here, one of the things, I'll just bring this up real fast. I would post on Twitter is the number of IPOs, right? This is not updated for 2022 yet, but I was talking about how the froth in the market was coming at the end of 2021, and how were we, what was the market going to do with that, right? And I was looking at the number of IPOs, right? This is IPO by year, right? And in 2021, there was 1,058 IPOs, right? More than there's ever been. I mean, this is going back. You could take a look at this chart real fast. In 2000, 1999, there's 486, right? In 07, it was 268. I mean, it's just like, when you look at it, look at these numbers. Nothing's ever been this frothy ever, as far back as my data goes, which is 99. And so now we're going to, now we're paying the piper. But that was an interesting stat, how you use IPOs to determine froth in the market. The problem with that is that it's not a timing mechanism, right? I had no idea if we could go another year and do 2,000 IPOs. I just didn't know. But that's just another signal, what I'm saying, when we build our cases for everything. We have the MACD cross, we have the IPOs that were coming out of out of last year doing on the monthly chart. These are big picture things. And I think that, again, caution is the name of the game right now. Play defense, preserve your capital, mental and emotional. Wait for that flush. I really, really think that there could be another flush coming that, getting us to this 300 level on the Qs. I think that's where to watch for. This 300 level on the Qs with the put call ratio going very, very bearish, with the percent of stocks above the 50-day moving average getting to that 10%, right? Maybe with bond yields calming down a little bit if they do spike up some. Those are all things that we can look at all together and then decide on, okay, here's a good risk reward to try along or something like that. But until then, good luck out there. Stay safe out there. I'm hoping that Ukrainians are able to defend their cities and survive what's going on there. Terrible situation. And yeah, anyway, take care of yourselves. Have a great day.